There is this incredibly common, almost universal feeling when it comes to personal finances.
Oh, yeah, for sure.
Like you log into your bank account, you look at your savings, and there is just this undeniable sinking feeling in your stomach, a feeling that you are somehow, I don't know, behind the curve.
Right, like you missed a memo somewhere.
Exactly. That you made a wrong move somewhere along the line. Or perhaps even worse, that you missed the boat entirely simply because you never learned the mechanics of how to start.
Yeah, it is a really heavy psychological burden. And honestly, the data shows you are absolutely not alone in feeling it.
I bet.
I mean, the financial industry is practically built on this foundation of complexity. They use dense jargon and, these seemingly high-stakes decisions that just leave everyday people feeling completely paralyzed.
Well, the source material we're diving into today drops this massive grounding statistic right at the top that validates that exact anxiety. Listen to this. 77% of U.S. adults have regrets when it comes to their personal finances. 77%. So you are entirely in the majority if you feel like you have messed something up.
A staggering number like that really tells us that navigating financial growth is fundamentally not intuitive.
Right.
Human beings are wired for, immediate survival. We aren't wired for projecting compound interest over a 40-year time horizon.
Totally. But the mission for our deep dive today actually stems from the second part of that data.
Okay.
Of those people feeling remorse, 22% say their absolute biggest financial regret is not saving for retirement early enough.
Yeah, that makes sense.
The regret isn't that they picked the wrong tech stock in 1999 or made a bad real estate deal. The regret is simply that they delayed getting into the game. So we are here today to make sure you don't become part of that 22%.
Because the cost of hesitation is ultimately much higher than the cost of starting small.
Exactly. Okay, let's unpack this. We have a guide here that breaks down 5 time-tested, beginner-friendly investment strategies.
Right, but before we explore how to deploy capital, the source is very strict about setting a baseline.
A reality check, basically.
Exactly. Realistic expectations are the foundation of any enduring strategy. The material emphasizes heavily, and I mean heavily, that investing is not a get-rich-quick mechanism.
Right.
If the goal is to double your money by next Tuesday, to pay for a vacation, the stock market is just the wrong arena.
Because the market goes down as well as up, right? And short-term volatility can wipe out funds you desperately need.
Precisely. That brings us to the absolute prerequisite mentioned in the text. Before you even consider putting $1 into the market, you must have your defensive finances in order.
Meaning an emergency cash savings account.
Yes. The logic there is incredibly sound. If you invest the money you might need to, say, fix your car or pay your rent next month, you are setting yourself up for forced liquidation.
Right. So, like, say your car transmission blows up and simultaneously the stock market just happens to be down 15% that month.
A total nightmare scenario.
Yeah. If you do not have a cash cushion, you're forced to sell your investments at a loss just to pay the mechanic. You turn a temporary market dip into a permanent personal loss.
And that is the exact mechanism of how people get burned and swear off investing forever. The money you invest needs to be entirely unburdened.
It needs room to breathe.
Exactly. It needs the luxury of time so it can sit there and weather the inevitable economic storms.
Okay, so assuming the emergency fund is fully stocked, the life raft is inflated, let's explore the actual mechanics of entering the market.
Okay.
Because knowing you need to invest is one thing, but actually pushing the buy button introduces this massive psychological hurdle.
Oh, absolutely.
How does a beginner actually start putting money in without being completely paralyzed by the fear of buying on the exact wrong day? I mean, the ultimate nightmare is buying on a Tuesday and watching the market crash on a Wednesday.
Yeah, the fear of timing the market is the primary barrier keeping people parked on the sidelines. But the source addresses this directly with a mathematical solution called dollar cost averaging.
Dollar cost averaging.
Right. And while it sounds like a complex quantitative formula, the mechanics are remarkably straightforward. It's just the practice of adding a consistent, predetermined dollar amount to your investments at regular intervals.
Just totally ignoring the current price or the daily news cycle.
Completely ignoring it.
I always like to visualize this using a gas station analogy.
Oh, that's a good one.
Yeah, let's say you decide to always spend exactly $50 on gas every time you visit the pump, regardless of the price per gallon.
Okay.
When gas is really expensive, say $5 a gallon, your $50 only buys you 10 gallons.
Right.
But when the price of gas crashes to $2.50, that same $50 bill automatically buys you 20 gallons.
Yes, exactly.
Without doing any complex math or trying to predict the oil market, your fixed dollar amount naturally forces you to buy fewer units when prices are high and more units when prices are low.
That perfectly illustrates the mathematical mechanism at play. By committing to a fixed dollar amount, whether that is $500 a month or $125 a week, you inherently lower your average cost per share over time.
It's almost like setting cruise control.
It really is.
Hmm?
When the market drops, human instinct screams at you to hoard cash and wait. Dollar cost averaging acts as an algorithmic override for that panic. It forces you to buy the dip automatically.
It essentially takes the emotional burden of decision-making completely out of the equation. You don't have to obsess over geopolitical news or interest rate hikes before making a deposit.
It does, but analyzing the source material requires us to be objective about the trade-offs here.
Okay, what's a catch?
Well, the consistent nature of dollar cost averaging guarantees you will not dump your entire life savings into the market at the absolute highest peak.
Which is good.
It is. However, it also guarantees you will not invest all your money at the absolute lowest trough.
Ah, so you're surrendering the fantasy of perfectly timing the absolute rock bottom in exchange for peace of mind.
Yes. A lump sum investment at the perfect moment will technically yield higher maximum returns. But consistently timing the market perfectly is virtually impossible,
Even for the pros, right?
even for institutional algorithms. What dollar cost averaging achieves is the construction of a substantial portfolio over time through the sheer power of behavioral discipline.
Okay, so the system is running, the money is flowing in automatically every month.
Right.
But the instinct to tinker is incredibly strong. You log into the app, you see a red number, and the immediate urge is to sell and stop the bleeding.
Naturally.
The source counters this urge with the buy and hold strategy. It advises listeners to hold investments indefinitely, or at least for 3 to 5 years, to allow the compounding process to work.
And the term indefinitely really highlights the required shift in philosophy here.
I have to push back on how difficult this is in reality, though.
Okay, fair.
The guide itself explicitly warns that a 50% or greater drop in value is entirely possible.
Yes, it is.
Individual stocks can collapse even further. If a listener logs in and sees half their wealth just evaporated on a screen, how does a normal human being maintain the fortitude to just hold?
This raises an important question, and it really gets to the defining challenge of wealth accumulation. Overcoming it requires a fundamental rewiring of how you view a stock.
How so?
To endure a 50% drawdown without panicking, you must stop viewing yourself as a trader betting on short-term price movements and start viewing yourself as a business owner.
So focusing on the underlying mechanics of the company rather than the daily ticker price.
Exactly. Consider a scenario where you own a highly profitable local bakery.
Okay.
If a major storm hits your town and foot traffic disappears for a week, the immediate value of your bakery drops.
Sure, nobody's buying bread.
Right. But you wouldn't panic and sell the entire business to a passerby at a 50% discount.
No, of course not.
You understand the ovens still work, the recipes are excellent, and people will invariably want bread when the storm clears.
Ah, I see. The intrinsic value of the business remains intact, even if the current market conditions are terrible.
The source reinforces that your long-term success is dictated by how the underlying business performs over decades. Avoiding the panic button is the only way to capture the market's biggest historical winners.
Because constant jumping in and out interrupts the mathematical magic of compound growth.
Exactly. Holding through the severe economic storms is essentially the admission price for earning exponential returns.
You know, beyond the mathematical returns, there is a massive lifestyle benefit to adopting the owner mentality.
Oh, definitely.
Committing to a buy and hold strategy frees you from the tyranny of the financial news cycle. You are not shackled to a computer screen staring at candlestick charts all day.
Right.
Your capital is doing the heavy lifting, allowing you to actually go focus on your career, your family, and your life.
Which leads us to the most complex hurdle for anyone starting out.
What's that?
You have the discipline to invest regularly and the emotional fortitude to hold. But the entire system falls apart if you do not know what to actually purchase.
Oh, yeah. Picking stocks is deeply intimidating.
Analyzing corporate balance sheets, understanding price-to-earnings ratios, and attempting to predict which tech startup will dominate the next decade, that is a specialized, full-time job.
And the source's solution to this barrier is what many consider the ultimate foundational hack for wealth building, which is buying index funds.
Yes. And to understand the power of an index fund, we first need to define an index.
Okay, let's do it.
An index, like the S&P 500 or the NASDAQ Composite, is essentially just a theoretical list. It tracks the collective performance of a specific, broad group of major companies.
I always picture it like buying a VIP pass to a massive music festival rather than trying to guess which single band is going to put on the best show.
That's a great way to look at it.
An index fund is a single financial product that buys a tiny fractional share of every single company on that list simultaneously. One transaction gives you instant, comprehensive diversification across hundreds of the world's most powerful corporations.
And the data supporting this approach is incredibly sobering for the financial industry.
How so?
Studies highlighted in the source consistently demonstrate that highly educated, deeply resourced Wall Street professionals typically underperform these simple, broad market indexes over a 10 to 20-year horizon.
Wait, really? The experts whose entire careers are dedicated to picking winning stocks are statistically losing to a passive, automated list.
Yes, the mechanics behind that failure are fascinating. Active fund managers charge high fees to cover their research and salaries. They also incur trading costs by constantly buying and selling.
Oh, right, all those hidden costs.
Furthermore, the stock market is highly efficient. Predicting the future better than millions of other market participants is incredibly rare. So rather than paying an expert a premium to attempt the impossible, an index fund allows you to simply own the baseline growth of the entire economy at a fraction of the cost.
Here's where it gets really interesting. The guide features this brilliant quote from Jack Bogle, the legendary founder of Vanguard, who essentially pioneered this exact philosophy.
Oh, I love this quote.
He compared the act of picking individual stocks to endlessly searching for a needle in a haystack. His revolutionary advice was to simply stop looking for the needle and just buy the entire haystack.
The haystack philosophy fundamentally shifts the burden of success. You no longer have to worry if one specific CEO makes a terrible decision or if one specific industry becomes obsolete.
Because you own all of them.
Right. You are placing a macro-level bet on human ingenuity, population growth, and the general upward trajectory of the global economy.
Plus, the index is naturally self-cleansing, right?
Yeah.
If a massive company in the S&P 500 slowly loses its edge and its value plummets, it automatically falls off the bottom of the list and is replaced by the newest, most innovative rising star.
Exactly. You never have to manage the roster.
But looking at the trade-offs, buying the haystack does cap your potential.
It does. When you purchase a massive collection of 500 different stocks, the basic laws of mathematics dictate that you will only ever receive their blended average return.
Right.
You eliminate the risk of your portfolio going to zero, but you also eliminate the possibility of experiencing a 10,000% overnight explosion from the market's single hottest individual stock.
So you are securing the steady historical average, which for the S&P 500 has been historically robust over decades, but you are permanently giving up the lottery ticket.
Exactly.
Which brings us to an interesting psychological pivot in the source material. Buying the haystack is mathematically sound, but human beings often crave a sense of agency.
They want to play the game.
Yeah. What if a listener genuinely wants to research companies or strongly believes in a specific technological trend?
The guide anticipates that desire and offers a framework to satisfy it without abandoning the safety of the baseline strategy. They call this hybrid approach index and a few.
Let's look at how this is structured. The core concept is isolating your risk. The source suggests keeping the vast majority of your capital, say 94 or 95%, securely locked into broad, passive index funds.
That forms the immovable foundation.
Right. Then you carve out a very small, calculated slice, maybe 5%, to actively invest in a handful of specific companies you have researched and genuinely believe in.
It functions very similarly to a core and satellite model used by institutional wealth managers. The massive index fund is the heavy anchor keeping the ship stable, while the individual stocks are small sails trying to catch a little extra wind.
It's kind of like having your dessert only after you've eaten all your vegetables.
That is a perfect analogy.
It gives a beginner the sandbox to learn the mechanics of active investing. You can learn how to read an earnings report, track profit margins, listen to investor calls. You get the thrill of participation.
Yes.
Crucially, though, if your analysis is completely wrong and that specific company goes bankrupt, losing that 5% will not derail your retirement timeline.
That built-in safety net is vital, But the source explicitly warns that managing those satellite positions requires genuine analytical work.
You have to do the homework.
You really do. You cannot treat that 5% allocation like a roulette wheel. If you are buying a stock simply because you recognize the brand name or because a friend mentioned it in passing, you are stepping away from investing and engaging in speculation.
You have to actually read the underlying financial health of the business.
Exactly. And to build on that, the effort required to properly evaluate even a single company's cash flow, debt load, and competitive advantage is significant. The index and a few strategy assumes you are actually willing to do that work.
Okay, so we have covered strategies that rely on the sheer growth of the share price over decades.
Right.
But the guide recognizes another fundamental investor need, the desire for tangible, immediate cash flow. Growth only helps you 20 years from now when you sell. What if a listener wants their portfolio to generate actual income they can use today?
That transitions us to the final major concept, income investing. This strategy pivots the focus away from explosive growth and targets assets that distribute regular cash payouts to the investor.
The primary engines for this are dividend-paying stocks and bonds. Let's break down the mechanics of dividends first, because it is important to understand why a company would just hand out cash instead of keeping it.
Right. It basically comes down to a company's life cycle. A young, aggressive tech startup will typically reinvest every single penny of profit back into the business.
Hiring engineers, building servers, expanding marketing.
Yes, because their goal is rapid expansion.
They need the capital to fuel the rocket ship.
But consider a massive, century-old consumer goods company that sells toothpaste and soap worldwide. They already dominate their market. Building one more factory won't drastically increase their global footprint.
Right.
So instead of hoarding their massive profits, they distribute a portion of that cash directly to their shareholders on a quarterly basis. That distribution is a dividend.
What's fascinating here is what the guide highlights as the real magic. The concept of dividend growth.
Oh, yes.
High-quality, mature companies do not just pay a flat rate indefinitely. Many have a track record of systematically increasing their dividend payout every single year. You buy the stock once, and the cash flow it generates for you continually expands, requiring zero additional effort on your part.
It is arguably one of the most robust forms of passive income. You can use that quarterly cash to pay your utility bills, or to maximize the math of compounding, you automatically reinvest those dividends to buy even more shares of the company.
Which then generate even more dividends the following quarter.
Exactly. And just like the haystack approach with growth stocks, you do not have to try and pick the perfect individual dividend stock. You can buy a dividend-focused index fund, instantly acquiring a diversified portfolio of hundreds of cash-generating companies.
But looking at the vulnerabilities, we do need to address the risks here.
The primary risk with individual dividend stocks is that the payout is never legally guaranteed. If a company faces a severe economic downturn or mismanages its debt, the board of directors can vote to slash the dividend or eliminate it entirely.
And as an investor, your passive income stream vanishes overnight. And usually the underlying stock price plummets simultaneously as other income investors flee.
Yeah, it's a brutal double hit.
Ouch. Well, the guide also heavily features bonds as an income generator. With a stock, you own a piece of the company. With a bond, my understanding is that you are essentially acting as the bank.
That is the precise mechanism.
You are loaning your money to a corporation or to the government, and they agree to pay you a fixed amount of interest, the yield, over a set period, before eventually returning your original loan amount.
Exactly. Bonds are mathematically designed to be much safer and less volatile than stocks, which is why they are a staple for capital preservation. However, the source points out a deeply insidious, silent risk associated with bonds. The risk of inflation.
Because the interest rate is locked in.
Yes. If you purchase a safe government bond that pays a 2% annual yield, but the broader economy experiences inflation running at 4%, the purchasing power of your wealth is actively decaying.
Right. The numbers in your account are technically going up, but in the real world, you can afford fewer goods and services than you could a year ago.
You are losing money safely.
Wow. Losing money safely. And speaking of losing money, there is a crucial, deeply practical structural tip the guide includes regarding income investing and taxes.
Oh, the tax drag is so often overlooked by beginners. If you hold dividend-paying stocks or interest-paying bonds in a standard taxable brokerage account, the government treats those payouts as taxable income in the year you receive them.
Every time cash hits your account, the IRS takes a slice, which severely blunts the snowball effect of compounding.
Yes.
So the source advises listeners to strategically place these specific income-generating assets inside tax-advantaged accounts, like an individual retirement account or IRA.
The mechanics of an IRA act as a tax shield. If your assets generate dividends inside that specific account structure, you do not pay annual taxes on the payouts as long as the money remains inside the account.
Wow.
It allows the compounding process to operate with absolute mathematical efficiency.
It just proves that understanding the structural container holding your money is just as vital as picking the right investment. So what does this all mean?
Well, to synthesize this entire framework for you, the journey from financial anxiety to competence does not require an advanced degree in quantitative finance.
No. You avoid becoming part of that 22% who regret waiting by deploying a cohesive system.
A system built on behavioral guardrails.
Yes. You use dollar-cost averaging to automate your habits and entirely bypass the psychological terror of timing the market. You adopt the buy-and-hold owner mentality to weather the inevitable economic storms without panic selling.
You're right.
You utilize index funds to build a massive, diversified foundation, buying the whole haystack to mathematically outperform the active professionals. And finally, you have the option to thoughtfully customize that foundation using a small percentage for individual conviction plays or shifting toward dividends for tangible cash flow.
It is an incredibly robust, democratized approach to wealth building.
It really is.
But analyzing the sheer scale of this advice leads to a rather profound, almost philosophical market question that extends beyond the source material itself.
The ultimate implication of everyone following this guide, what is the paradox here?
Consider the core premise. Buy the broad index fund blindly and consistently, ignoring the specific valuations of the underlying companies. For the individual investor, it is undeniably the optimal strategy.
Right.
But a stock market relies on active price discovery analysts evaluating whether a specific company is actually innovating, growing, and deserving of capital.
Oh, I see. If I buy an S&P 500 fund, my money is automatically distributed to the largest 500 companies purely based on their current size, rewarding them simply for already being massive.
Exactly the paradox.
Good.
If millions of everyday investors armed with trillions of dollars in retirement accounts abandon active analysis and exclusively funnel their wealth blindly into the exact same passive haystack, who is left to actively determine what those companies are actually worth?
That is a crazy thought.
Does the sheer overwhelming popularity of passive investing eventually distort the fundamental mechanics of the market itself? Can the haystack become so heavy that it breaks the scale?
It is a brilliant, slightly unsettling ripple effect to ponder as these passive strategies completely dominate the modern financial landscape. Will the sheer volume of cruise control investing eventually change the shape of the road itself? That is a deep economic theory to mull over.
Definitely something to think about.
But for your personal financial journey, engaging that cruise control and getting your capital out of the driveway remains the single most critical step you can take. Do not let the fear of market mechanics keep you parked in cash, watching the decades roll by. Thank you for joining us on this deep dive, and keep exploring.